Welcome back to the Deep Dive. This is where we take your entire stack of sources, the dense articles, the complicated research, your personal notes, and synthesize it all into the deep knowledge you need, delivered efficiently and engagingly.
That's right.
Today, we are undertaking a deep dive into a concept so fundamental it dictates, well, the growth of civilization, the state of global trade, and even your personal spending habits. Interest.
It really is the single most pervasive price in the entire financial world. And our sources today, they really reflect that breadth. We're looking at a remarkable historical sweep, moving from, 5,000-year-old Sumerian documents right up to 21st century theories of liquidity.
And what's our mission here?
Our mission is critical, to move beyond just calculating interest and to truly understand the historical, moral, and mathematical underpinnings of why we pay or receive the price of money.
Okay, let's unpack this. We use the word interest constantly, but I think it sometimes gets conflated with other financial terms. So to start, let's nail down the core, pure definition.
Fundamentally, interest is the cost of borrowing money. It's a payment made by a debtor or a borrower to a lender, or sometimes a depositor, of an amount that is specifically above the repayment of the principal sum.
Okay, above the original amount.
Exactly. And crucially, this payment is predetermined and paid at a particular rate over a specific period.
And the roles here can sometimes be confusing. If I put, say, $10,000 into a savings account, who is the lender and who is the borrower?
That's a great question because it feels backwards. In that case, you, the customer, are the lender. You are supplying the bank with your capital.
So the bank is the borrower.
The bank is the borrower. They pay you interest for the use of your money, which they then, of course, lend out at a higher rate. The interest rate itself is merely the amount paid or received over that period divided by the principal sum, and it's usually expressed as an annual percentage.
We absolutely must distinguish this from other common financial terms.
Mm.
Otherwise, the accounting gets messy. For example, interest versus a fee.
Yes, a crucial distinction. Interest is entirely dependent on the principal amount, the rate, and the time the money is used. A fee, by contrast, is a fixed charge. It's paid to a lender or a third party, usually for processing, administering, or underwriting the loan.
So like a loan origination fee.
Exactly. A loan officer's fixed commission is a fee. The 7% annual charge on the remaining balance is the interest.
And what about equity? If I invest in a successful company and I get a quarterly payout, that's a dividend. Why is that not considered interest?
Because the nature of the relationship is entirely different. Interest is received by a lender based on a contractual preset rate.
Yep.
A dividend is received by a shareholder who is, by definition, an owner of the company. As an owner, you assume risk.
So there's risk involved.
A huge amount of risk. The dividend is paid out of the company's actual profits, and its amount is determined after the fact, based on how well the company performed. It's a pro rata share in the reward for that risk-taking.
So the core distinction is, interest is fixed and contractual, paid to a lender. A profit or a dividend is variable, and it's paid to an owner or an investor who shared in the actual risk.
Exactly. It separates the idea of lending capital from the idea of risking capital. And once we understand interest as the price of time and capital, we have to immediately discuss the dynamic engine that drives that price: compounding.
Here's where it gets really interesting. Compound interest, which Albert Einstein may or may not have called the eighth wonder of the world.
Right, that's probably apocryphal.
Probably. But it's a great line. It's the idea that you earn interest not only on the original principal, but also on all the interest that has already accumulated.
It creates exponential growth. If your savings account compounds quarterly, the second quarter's interest is calculated on a slightly larger principal than the first. It snowballs the growth.
And it works the other way, too, with debt.
Oh, absolutely. On the debt side, if you miss a credit card payment, the interest from that missed month is immediately added to your principal, and your next interest charge will be calculated on that larger inflated amount.
And this exponential nature of compounding is so central to our understanding of finance that, as you noted, its mathematical study led to the discovery of the fundamental constant E.
Yes, we are absolutely going to dive into that deep math later. But first, let's establish the context, because the story of interest is, it's older than democracy.
Is it really?
Oh, yeah. And it's a story rooted in surprising necessity. The sources make it clear that credit, the ability to loan and borrow, predates coinage by millennia.
Millennia.
The first concrete written evidence of systematic credit comes from Sumerian documents, specifically cuneiform tablets, dating back to 3000 BC in Mesopotamia.
3000 BC, that is staggering. What were they loaning? It wasn't cash.
No, the loans were primarily in grain, the agricultural staple, and silver, which served as the standardized metal. And what's crucial is that these were systematic, institutionalized loans used to manage the cyclical nature of agriculture. A farmer might need grain for planting season, and they'd promise repayment after the harvest.
So what was the early justification for charging interest on, a bag of seeds or a piece of silver?
The theory likely arose from the most practical observation: productivity. If you loan a shepherd 10 sheep, those sheep will reproduce. If you loan a farmer 10 measures of grain, those seeds will multiply in the field.
So the lender felt they deserved a cut of that natural growth.
Exactly. The lender argued, quite reasonably, that they deserved a share of that natural multiplication, arguing the acquired goods could multiply themselves. This established the idea of a natural yield, or interest.
That makes perfect sense for productive assets like livestock, which literally reproduce. But what happens when that same rate, and the sources say it was around 20% annually, is applied to something that doesn't reproduce, like silver?
And that is precisely where the philosophical tension and moral objections began, almost immediately. The first written evidence we have of compound interest dates to roughly 2400 BC, where that standard annual interest rate of about 20% was codified, and it was often applied to both grain and silver.
And while that system was obviously essential for urbanization and managing harvests,
It was.
the fairness of charging 20% on what they called sterile silver money that doesn't inherently grow, that became a massive point of contention.
Huge. And this contention leads us directly into the concept of usury, which for most of history didn't just mean excessive interest, but often any interest at all, especially when you were lending to a co-religionist.
That's right. The strong moral and religious prohibitions appeared very early.
They did. For instance, in the ancient Jewish faith, there were prohibitions against charging neshek, or usury, to other Jews. This reflected a necessity-based tribal view, where lending money to a neighbor, well, it should be an act of charity, not a commercial transaction designed to profit from that neighbor's misfortune.
And that prohibition was powerfully adopted and then expanded by early Christianity during the Roman Empire.
Dramatically so. The First Council of Nicaea in 325 AD strictly forbade clergy from practicing usury, and they defined it as lending above 1% per month.
Which works out to, what, about 12.7% a year?
Roughly, yes. And later, the moral condemnation expanded to the laity, culminating in the powerful arguments of St. Thomas Aquinas in the 13th century.
What was Aquinas' specific theological argument against charging interest?
He argued it was intrinsically wrong because it constituted double charging. He used Aristotle's definition that money is sterile. It's just a medium of exchange, not a productive asset like a farm or a workshop.
Okay, so how is it double charging?
By charging interest, you are effectively selling the buyer the principal sum and then charging them separately for the use of that sum. But since the use and the principal are inseparable when you're dealing with sterile money, you're basically selling the same thing twice.
That really reflects the economic reality of the time, doesn't it? If you needed a loan in the medieval period, it was almost always a tragedy. Your house burned down, your sheep died. It was a loan of necessity for consumption.
Exactly. It wasn't a productive investment that would yield a profit for the borrower.
So the moral reproach was based on the fact that the lender was profiting from someone else's necessity and distress, and the money itself wasn't creating any new goods or services. There was no productive value.
None at all, in their view.
So if the moral framework was so rigid, how did the West eventually transition to a world where charging interest is, it's just standard practice?
The catalyst was the Renaissance. It was the explosion of commerce, of trade, of mobility. Money stopped being primarily a cushion against poverty and started becoming a tool of production.
So when borrowed money was used to finance a new voyage or equip a printing press.
Or start a new business activities that generated significant wealth, the moral perception shifted entirely. The interest became compensation for the lender's opportunity cost and the risk of the new enterprise, rather than just profiting from distress.
The philosophical justification changed from the lender profits from my need to something like the lender deserves compensation because their money enabled my profit.
That's the intellectual jump that eventually legalized and normalized interest across the secular economies of Europe. However, that moral objection, riba, it remains central to Islamic finance today.
Let's look at that framework because it's a powerful modern example of how to run a complex financial system without the mechanism of predetermined interest.
The modern Islamic banking movement grew significantly in the later 20th century, and the central prohibition remains: making money out of money is unacceptable. Predetermined loan repayment, or riba, is prohibited. This means a standard loan contract with a fixed interest rate is impossible.
So if a bank can't charge a fixed rate, how does a financial institution profit, and how do savers get a return?
They share the risk. The financial institution acts as a partner, not a lender. This is achieved through profit-loss sharing schemes. For instance, instead of lending you money to buy a house and charging 6% interest, the bank might enter a joint venture, a musharaka, or a cost-plus profit contract, a murabaha, to finance the purchase.
Can you give us a specific example of how that might work?
Sure. Let's say you're purchasing a piece of equipment for a business. Under an Islamic banking model, the bank might purchase the equipment outright and then lease it to the business for a fixed agreed-upon period. The lease payments would be determined by the asset's use and depreciation, not a floating interest rate.
Or they could become partners.
Or, more commonly, they act as partners, mudarba, investing capital and sharing the eventual profits according to a pre-agreed ratio. But, and this is key, they also share in any eventual losses.
What's fascinating is that this requires all transactions to be asset-backed. They can't just lend cash against nothing.
Precisely. The money has to be tied to a real-world, productive asset or enterprise. This inherently forces financial institutions to focus on the productivity of the economy, the very justification that helped lift the usury ban in the West, but without reverting to a predetermined contract rate. It emphasizes that money must be used to create wealth, not just be extracted from debt.
That provides an incredible transition. If the philosophical justification hinges on productivity, then the mechanical growth of that productive wealth is what we need to focus on next. The mathematics of interest.
Right. Let's move from philosophy to pure math, starting with the distinction between simple and compound interest. Simple interest is what we first look at in school, and it's calculated only on the original principal amount, completely excluding any compounding effect.
Okay, so if a listener has a loan or credit card that charges, say, 12.99% annually, let's walk through how simple interest would be calculated on a $2,500 balance.
Okay. If that 12.99% annual rate, or 0.1299, is applied over 1 month, and we assume 12 payment periods in a year, you just calculate the simple interest for that month. It's the annual rate times the principal, divided by the number of periods.
So that's 0.1299 times 2,500 divided by 12.
Which comes out to approximately $27.06. So if the borrower paid exactly that amount, their principal remains at $2,500.
And if they did this for 3 months, the total simple interest would be just 3 times that amount, so about $81. The calculation stays flat.
It stays completely flat, exactly. It ignores any interest that might have accrued.
That sounds wonderfully manageable. But as we know, the real world is almost entirely dominated by compound interest, which is where things become exponential and, well, potentially far more punitive if you're borrowing.
Compound interest is what happens when the interest earned or charged is added back to the principal, and subsequent interest calculations are based on that newly inflated balance. The frequency of compounding daily, monthly, semi-annually is what determines the effective rate of growth.
Let's use a quick comparison to show the impact of that compounding frequency. Imagine 2 investments, both with a 6% simple annual rate. One is an annual CD. It pays 6% once a year. The other is a bond that pays 6% semi-annually, so 3% every 6 months.
Okay. On a $10,000 investment, the annual CD simply pays you $600 at the end of the year. The semi-annual bond, however, pays $300 after the first 6 months. This is the crucial moment for the compounding effect.
Because the bondholder can immediately reinvest that $300.
Yes. They now have a principal of $10,300 for the next 6 months. So when the second coupon is paid, it's 3% of that larger amount, which is $309.
So over the full year, the investor has earned $300 plus $309 for a total of $609.
Right. So even though the stated rate was 6%, the investor's effective annual rate, the AER, is actually 6.09%. That extra $9 is the direct result of the compounding frequency.
And this leads us to the formal mathematical expression for that annual equivalent rate.
It does. It's 1 plus r divided by n, all raised to the power of n minus 1, where r is the nominal annual rate and n is the number of compounding periods per year. In our bond example, that's 1 plus 0.06 over 2 squared minus 1, which gives you 6.09%.
This simple realization that increasing the frequency of compounding increases the rate of return is what led Jacob Bernoulli to his profound discovery of the constant E, This is a perfect example of how finance drives pure mathematics.
It truly is an aha moment in history. Bernoulli, back in 1683, was pondering what happens if you take that compounding process to its logical extreme. He devised a thought experiment. Start with $1 and offer a 100% annual rate.
Okay, so compounding annually gives you $2.
Right. Compounding semi-annually yields $1 times 1.5 times 1.5 again, so $2.25. If you compound monthly, the return jumps to about $2.61. Bernoulli wondered, what happens if we compound infinitely often, every second, every nanosecond? Does the result become infinite?
You would intuitively think that, yeah, if you divide the interest rate by an infinite number of periods, you get an infinitely growing return.
But Bernoulli proved that it doesn't. As you increase the frequency of compounding, n, toward infinity, the calculation approaches a finite, fixed limit.
Why is that?
Because the increase in frequency is offset by the corresponding infinitely small division of the rate. The gain from the frequency increase is exactly balanced by the rate dilution.
Wow.
Precisely. And that specific finite limit, where continuous compounding occurs, is the mathematical constant E, approximately 2.71828. It is the limit as n approaches infinity of 1 plus 1n to the power of n.
That's amazing. The drive to understand the best way to earn interest led to the discovery of one of nature's most fundamental numbers.
And it now governs everything from population dynamics to pricing complex financial derivatives today, which rely on the concept of continuous compounding.
Now, moving from the purely theoretical math to the practical back-of-the-envelope math, we need to share some rules of thumb for the listener. The first is the famous Rule of 72.
The Rule of 72 is perhaps the most useful piece of financial shorthand for approximating how long it takes for an investment or a debt to double. You just take the number 72 and divide it by the annual percentage interest rate.
So if you manage to find an investment yielding a steady 6% annual return,
72 divided by 6 is 12. It takes approximately 12 years for your principal to double. This is enormously useful for retirement planning.
and on the flip side,
On the flip side, if you are struggling with a high-interest credit card at 18%, 72 divided by 18 means that debt principal will double in only 4 years, assuming you pay nothing down.
our sources note that this rule works incredibly well for interest rates up to about 10%, but what about outside that range?
It's still a very good approximation. For a very low rate, say 4%, the Rule of 72 suggests 18 years, while the actual doubling time is closer to 17.7. For a very high rate, like 36%, the rule suggests 2 years, but the actual time is closer to 2.25. It's an easy rule to memorize, and the error is generally small enough to be useful for quick decisions.
The Rule of 72 is helpful for the future, but we have to issue a serious warning about a historical rule of thumb that actively punished borrowers: the Rule of 78s.
This is a truly dark and, frankly, exploitative chapter in consumer finance history. The Rule of 78s, also called the sum of digits method, was used widely for calculating interest allocation on flat-rate consumer loans in the U.S. and Canada before computational power became ubiquitous.
The name comes from the fact that the sum of the integers from 1 to 12 is 78, reflecting a one-year loan. How was this method used to disadvantage the borrower?
Well, first, the total interest due over the entire life of the loan was calculated upfront. Then, that interest was allocated using a weighted system, but in reverse. For a one-year loan, the lender deemed 1,278ths of all the interest to be due in the first month, 1,178ths in the second, and so on, until the last month where only 178th was allocated.
So the interest payments were severely front-loaded. You might pay the same dollar amount every month, but the allocation meant you were paying off the interest component first.
Precisely. For a borrower, the practical effect was brutal. For a one-year loan, approximately 3/4, or 75%, of the total interest owed was collected by the lender within the first 6 months.
So if you came into some money and wanted to pay off your loan early,
You'd be shocked to find you were entitled to almost no refund on interest, having already paid the vast majority of it. It effectively made early payoff financially punishing, trapping borrowers into paying interest for the full term.
that's predatory.
It was recognized as such. Thankfully, legislative action was taken. The U.S. outlawed the Rule of 78s for mortgages and other long-term consumer loans, specifically those over 5 years, starting in 1992. It's a stark reminder that the methodology of calculation is just as important as the stated rate.
One final quick note on calculation. How do instruments like T-bills or Treasury bills calculate interest?
Yeah.
They're different, right?
They are. T-bills are known as discount instruments and use a specialized method. They don't pay periodic interest payments. Instead, the interest is calculated based on the difference between the face value and the price you paid when you bought it.
So if a $1,000 T-bill is sold for $980, the $20 difference is the interest you earn when the government pays you the full $1,000 at maturity.
Correct. The buyer is discounting the future value to arrive at the current purchase price. And that interest is prorated using a simple interest calculation based on the number of days until maturity. It's an inverted calculation method, but the principle remains the same.
Okay, with the history and the math covered, we now shift our focus to the macro view. How are these rates determined in the actual market? Economically speaking, interest is the price of credit.
And like any price in a market economy, it's driven by the scarcity of the commodity, in this case loanable funds, and the intersection of supply and demand. The fundamental reason interest rates are generally above zero is that loanable funds are scarce, and there's always competing demand for them.
But the price of credit isn't uniform. I mean, a bank might offer 0.1% on a savings account, charge 5% on a mortgage, and demand 25% on a credit card. Why the massive variation?
Because the nominal rate that the borrower sees is a compound of several distinct factors. We can break the nominal rate down into four essential components. The first is the real rate, which you can think of as opportunity costs and deferred consumption.
This compensates the lender for giving up the use of their money now.
Exactly. The lender is deferring consumption. They need to be compensated not just for the delay, but also for the foregone return they could have achieved by investing in the next best alternative. If a 1% risk-free return is possible elsewhere, the real rate has to be at least 1%.
The second factor, and the one that feels most immediate to consumers, is inflation.
Right. Since we're dealing with time and loans often span years or decades, the lender faces the risk that future dollars will buy less than current dollars. If inflation is 3% and they charge 3% interest, they are simply preserving their purchasing power, not making a profit.
So how does the market typically handle the uncertainty of future inflation?
Three main ways. Some governments issue real return or inflation index bonds, where the principal value is continually adjusted for inflation, which removes the guesswork.
But that's not common for most loans.
No. So most other lenders must either estimate the expected inflation rate, which is inherently risky, or they use variable floating rates that can be reset periodically to adapt to changing price levels.
And that estimation is tough. We've seen periods like during the 2011 commodity spike or the high inflation of the 1970s where the real rate of return on government bonds was actually negative.
A painful lesson that market expectations are not guarantees. The third crucial factor is default risk, or creditworthiness.
This is the risk that the specific borrower will fail to repay the principal and interest.
This risk demands a risk premium, a higher rate to compensate the lender for the chance of total loss. This premium is heavily dependent on the integrity of the borrower and the collateral they offer.
Which explains why a consumer with a low credit score pays a much higher rate than a large corporation.
And why loans to developing nations carry significantly higher risk premiums than loans to established, stable governments like the US or Germany. And collateral, as you mentioned, matters immensely. A secured loan, like a mortgage where the house is collateral, will always carry a lower rate than an unsecured line of credit.
Okay, and finally, the fourth factor is the term and liquidity of the loan.
Term refers to duration. Generally, shorter terms have lower default risk because the near future is easier to predict. This typically results in an upward-sloping yield curve. You get paid less to lend money for 3 months than for 30 years.
And liquidity?
Liquidity refers to how quickly the lender can resell or liquidate the asset. A U.S. Treasury bond is highly liquid and can be sold instantly, so it offers a lower return. A highly illiquid loan, like seller-financed debt on a specialized piece of equipment, demands a significant liquidity premium to compensate for being locked into that agreement.
So if we synthesize these four components, we arrive at the nominal rate, I, that the consumer sees. And there's a formula for this.
There is. You can express it as I equals R plus pi plus C. So the nominal rate equals the real rate R plus expected inflation pi plus the credit risk yield spread.
Walk me through a real example, a 30-year mortgage.
Okay. A bank assesses the underlying real rate required by investors, say 1.5%. They estimate the average annual inflation pi over 30 years, say 3%. And then they add a credit risk and liquidity premium C for that specific borrower, say 1%. The resulting nominal rate I is 1.5% plus 3% plus 1%, which is 5.5%. That's the rate you're quoted.
That framework provides perfect clarity on how the price of money is constructed piece by piece.
Yeah.
Now, we touched on default risk, But we must clarify default interest.
Right. Default interest is a highly specialized risk premium. It is a much higher rate, sometimes dramatically so, that is contractually triggered only if the borrower commits a material breach of the loan agreement, like failing to make a payment.
It is essentially a penalty rate.
It compensates the lender for the fact that the borrower has now become high risk. The interest rate on the remaining principal might jump from 5% to 15%. However, many jurisdictions have complex laws regarding default interest. If the rate is deemed excessive, if it penalizes the borrower far beyond the actual loss incurred by the lender, courts can deem the clause unenforceable.
All these market factors determine the rate in a theoretical free market. But the biggest influence on rates worldwide is not demand for mortgages, but government intervention via the central bank.
Absolutely. Central banks, like the Federal Reserve in the U.S. or the European Central Bank, hold immense power over short-term rates. It's their primary lever of monetary policy. They do this by targeting what the U.S. calls the federal funds rate, the rate banks charge each other for overnight loans.
And the main tool they use to hit that target rate is called open market operations. Could you walk us through the actual mechanism? I mean, how does the Fed buying a bond affect my car loan rate 6 months later?
It's a chain reaction. When the Fed decides it wants to lower rates to stimulate the economy, it buys U.S. Treasury securities from the market.
Wait, so the Fed is buying bonds. Where does the money come from? Are they just creating it?
In essence, yes. They are crediting the accounts of the banks they buy the bonds from. When the Fed buys $1 billion in treasuries, it injects $1 billion of new money into the financial system, specifically into the bank's reserve accounts at the Fed.
So the banks suddenly have excess cash lying around in reserves.
Precisely. They are now sitting on excess reserves, money they must use or lend to maximize their return. To get rid of this excess liquidity, they lend it aggressively to other banks in the overnight federal funds market.
And more supply means a lower price.
Exactly. An increased supply of funds in that market causes the federal funds rate to drop. And since that rate is the base cost of borrowing for the entire banking system, the lower rate then ripples out, making everything from mortgages to corporate bonds cheaper.
And conversely, if they want to raise rates, they sell treasuries, which pulls cash out of the system.
It pulls cash out, tightens reserves, increases the demand for overnight lending, and forces the federal funds rate higher. It proves that while rates are determined by real factors, they are heavily managed by monetary policy targeting liquidity.
That brings us perfectly to the final, deepest section of our dive, the great debates. We have now defined interest, calculated it, and seen how the market prices it. But we still haven't fully explained why interest must exist. This is where economists have fought for centuries.
This is where the core ideological conflicts lie. If you ask Turgot, Keynes, or Rothbard why interest exists, you get 3 completely different yet compelling answers.
Let's start with the earliest scientific explanation from the Enlightenment, the French economist Henri Jacques Turgot in 1770 and his fructification theory.
Turgot, moving away from moral arguments, sought a scientific rationale for rates being greater than 0 based on opportunity cost, a key concept we discussed earlier. He compared the loan rate to the inherent reproducible return on agricultural land or capital.
He argued that if money wasn't invested in a loan, it could be invested in productive land.
Yes, and his genius was providing a mathematical proof for the necessity of a positive interest rate. He focused on the concept of land value as a perpetuity, a piece of capital that yields revenue indefinitely.
How does that math work?
The value of any perpetual income stream is calculated by taking the annual yield and dividing it by the prevailing interest rate. If your land yields $100 per year and the interest rate is 10%, that land is worth $1,000.
Okay.
Turgot argued that if the interest rate mathematically approached 0, the denominator in that equation would approach 0, and thus the value of the land would approach infinity.
A piece of land that yields $100 a year would be worth an infinite amount of money if the interest rate were 0.
Turgot argued this was economically and mathematically absurd. Therefore, for the entire economic system to make sense, and for capital assets like land to have a positive and finite price, the interest rate must remain above 0.
Moving forward a century, we have the classical theory, championed by economists like John Stuart Mill, David Ricardo, and Irving Fisher. They saw the interest rate as a market clearing mechanism.
The classical school argued that the interest rate adjusts to maintain equilibrium between the supply of loanable funds, driven by people saving, and the demand for loanable funds, which is driven by businesses investing.
So the interest rate is merely the price that balances the desire to save with the desire to invest.
Correct. And the primary regulator of this rate, they argued, was the marginal efficiency of capital, or MEC. The MEC is the annual revenue yielded by the next or extra increment of capital investment expressed as a proportion of its cost.
So if a business expects a new project to yield a 10% return, the MEC, they will only borrow money as long as the interest rate is below 10%.
Precisely. They'll keep investing until the borrowing rate equals that marginal expected return. The equilibrium is achieved when the desired saving function intersects the investment schedule.
But John Maynard Keynes, during the Great Depression, famously leveled two major critiques against this seemingly neat classical picture.
Keynes' critique was fundamental. First, he noted that the classical theory fails to explain a clear real-world observation. Why does an increase in the money supply tend to reduce the interest rate, at least initially? In their framework, money supply is separate from real saving and investment.
He called this a circular argument.
Yes. And his second critique was structural. The classical theory requires you to know the interest rate to determine the scale of investment, but the scale of investment is needed to calculate the marginal efficiency of capital. He found it was a circular dependency that was unsatisfactory for explaining real economic cycles.
So Keynes shifted the focus entirely away from productivity and saving towards something purely monetary, liquidity preference.
Keynes argued that interest is determined not by the supply and demand for capital, but by the demand for money for liquidity, and the supply of money created by the central bank. Money, unlike a bond, provides immediate flexibility and safety. It holds a liquidity advantage.
And interest, therefore, becomes the reward you have to receive for parting with that advantage.
That's the essence. People demand money for three primary motives: the transactionary motive, money for day-to-day purchases; the precautionary motive, holding cash for emergencies; and the speculative motive, holding cash to take advantage of future investment opportunities. The higher the rate of interest offered, the more willing people are to give up their liquidity and buy a less liquid asset, like a bond.
And you mentioned he built on the work of Silvio Gesell.
We have to acknowledge Gesell. He was a 19th century economist who theorized that interest is a purely monetary phenomenon. He observed that interest existed in monetary economies, but seemed absent in pure barter economies.
And his theory was that money doesn't spoil.
Right. Unlike grain or milk, money doesn't incur storage costs, which gives it a significant advantage. Keynes recognized this insight, but clarified the specific advantage of money as liquidity, the ease of exchange and reduced risk, which is why people are willing to pay a premium or interest to borrow it.
Moving on, we have the Austrian School of Economics, represented by Murray Rothbard, who rejected the entire focus on the loan market as being, well, secondary.
The Austrian theory argues that the loan market rate is merely a symptom, a manifestation of a far deeper pre-existing economic reality, the natural phenomenon of time preference.
Time preference being the psychological reality that humans prefer goods in the present over the exact same goods in the future.
Absolutely. If I offer you a glass of water now or 2 glasses of water next week, most people will take the single glass now. That inherent preference for present satisfaction is reflected in all economic decisions. Rothbard argued that focusing solely on bank loans misses the fundamental point.
So where do they see the real rate of interest reflected, if not in a bank contract?
That they see it in the price spreads between the various stages of production. Think of it this way. Consumers' goods, like a finished cake, are present goods. Producers' goods, like the oven and the flour, are future goods, used to create the present good later.
The cost difference between buying the finished product today versus buying the means to produce it reveals the time preference of society.
That's the Austrian insight. The price spread between the raw material stage and the finished product stage is the true natural rate of interest. This rate, driven by human psychology, then trickles down and determines the rate banks must charge. They criticized Keynes for ignoring this fundamental psychological reality.
Finally, let's bring in Wicksell, whose work provided a comprehensive theory linking the real economy to the monetary one, distinguishing between the natural rate and the nominal rate.
Wicksell, writing around 1898, introduced a crucial distinction. The natural rate is the hypothetical equilibrium rate of interest that would exist in a purely barter economy. The rate determined purely by real factors like productivity and time preference. It's what the rate should be.
And the monetary rate is what banks actually charge in a cash economy.
Yes. And Wicksell's major insight was that when the monetary rate diverges from the natural rate, economic instability results. If the central bank pushes the monetary rate below the natural rate, making borrowing too cheap, it encourages excessive investment and credit expansion, causing inflation to rise.
And conversely, if the central bank holds the monetary rate above the natural rate, it stifles investment and saving, leading to economic contraction and deflation.
Wicksel's work was hugely influential. It provided the conceptual framework for later theories and demonstrated how the actions of a central bank can either stabilize the economy by aligning the monetary natural rates or destabilize it by creating divergence.
It is truly fascinating that the same phenomenon interest can be attributed simultaneously to Turgot's mathematical requirement, to Keynes' concern about liquidity, or to Rothbard's deep psychological theory of time preference.
It underscores the complexity. Interest isn't just one price, it's a reflection of productivity, risk, expectation, and human psychology all rolled into one.
That brings us to our conclusion. We've navigated a journey from a simple definition, tracing its moral struggle back to Sumerian grain loans, through the precise mathematics that led to the discovery of the constant E, detailing how market risk and central bank intervention construct the final price, and finally, examining the deep, conflicting economic theories that still drive global policy decisions today.
And before we wrap, let's just revisit the idea of an interest-free economy, like modern Islamic finance. While they successfully remove riba, the pure, predetermined component of interest, it is important to remember that financial institutions still incur costs and risks.
Right. We established earlier that the total interest rate is actually composed of four parts: your interest, a risk premium, inflation expectations, and administrative costs.
In a Sharia-compliant system, the pure, risk-free interest component vanishes by definition. But the financial institution still needs to cover its administrative costs and still deserves compensation for sharing in the risk, which is the risk premium. This compensation is simply structured as a profit share or a lease payment rather than a fixed interest rate. So financial activity continues just under a different shared risk framework.
Which brings us back full circle to the philosophical and psychological root of all these debates: the value of time. The theories we explored, from the need to compensate a lender for deferred consumption to the innate desire for immediate satisfaction, they all boil down to pricing time itself.
Indeed. It's not just about money, it's about human nature. Every economic decision you make, whether to take a lump sum now or wait for a larger annuity later, whether to pay off debt early or stretch out the payments, is an expression of your personal time preference.
So we leave you, the listener, with this final provocative thought. Given that interest is rooted in the intrinsic human desire for instant gratification, preferring a good now rather than later, every time you accept or charge an interest rate, you are putting a tangible dollar value on your willingness to pay or be paid to wait. What does your own personal preference for time reveal about your economic philosophy, and how will that dictate your financial choices moving forward? Thank you for joining us for this deep dive.